this phenomenon. So, quick question. So, icebreaker for today. You have $100 and a store will sell you your favorite sneakers for that much money. You could buy it today or you could save for 10 years. What do you do? Okay, Seth, let's pick a few students to get their takes.
Sounds great. I see Ramit Pathak. You seem super excited, so go for it.
Okay, so I would buy my favorite. Uh, okay, I would buy my favorite sneakers and save them because that money after a certain time will not be worth $100 and will be worth less, like maybe $80.
Hmm.
Okay, and save them in a collector. I like it. Those Air Jordans in the closet, that might be your retirement fund. That's awesome. Okay, let's go with Paruthi Yadavir. Paruthi? I think you've got two cameras there. Yeah, go ahead. Oh, unmute yourself, please. There you go.
And Parvati Adavir, I would just buy it now for $100 and save it for 9 years and sell them. So
Okay.
it's a limited edition. It will sell for like $1,000, $2,000, but it's not a limited edition and it's getting a discount again. I get the loss again. I would get the loss.
All right, fair enough. And that's great. What do you think, Matthew? Do we have time for one more? What do you think?
Yeah, let's go for one more. Let's rock.
Okay. Radit, now that I've got your name correct, come on back and tell us what would you do in this situation?
So I would save that money because that money could increase in the next decade. And what about the shoes price? The shoes price could decrease and you could even get more varieties.
Oh, I love these different strategies. That is so
Yeah.
great. Okay, Matthew, what do you think about that?
Yeah, I mean, it's just really interesting because, right, like the sneakers could be more valuable. You could deploy the cash in different ways. I think the core is that just sitting on your money is a bad idea. And the spoiler on the bottom, as you can see, is that $100 might only buy $74 worth of stuff after a decade. So, whatever you do, just putting it under your mattress in the closet, forgetting about it somewhere, that is, whatever you do, that is the wrong answer. But a lot of your answers were super creative. I love it.
Now, sorry, Matthew, just to cut in here real quick. Um, it's great to see everyone thinking, and this is the way that we want to be thinking about this and these different angles. Before we get into Matthew's full presentation, I just wanted to take a moment to highlight the achievements of one of our students here, Anna Pont in grade 5, and she was globally recognized for her environmental protection initiative. Anna, are you with us today?
Yes.
Could you tell us a little bit about what you did and the awards you received?
So in 2024, my sister had a holiday homework about like planting saplings in during our summer break. So I joined her and me and my sister did it together. And till now, we have planted 153 saplings in our old society. And through that, my mother initiated me to make a video to maybe like get selected for the global recognition. And from I think each country, 2 or 3 people are like chosen, and from India, I'm one of them.
Wonderful. Wow,
Yeah.
that is
So,
just incredible.
so I can
And
see your screen.
okay, So really just amazing. And the fact that you worked with your sister on that as well is incredible. Yeah, it's just really great work there. So I'm trying to show everyone the video here, and if you just bear with me, hopefully I can be able to share that with everybody. Is that the right thing? No, I'm not sure if that's the right thing.
We can see your file selection. Oh,
Yeah,
now
I don't think that was correct. Yes, sorry about that. Pranay, if you have that available to share, but unfortunately right now my browser tab does not want to share correctly. But I think more importantly, Anna's view of and telling us about what happened there, planting trees and really combating deforestation is huge to the long-term survival of the planet. And to do that at such a young age, there we go. Thank you, Pranay. To do that at such a young age and to understand the impact that that has is really planting for the future. So thank you, Anna. And that's a global impact that you're making. Thank you very much.
yeah,
Um,
huge.
Incredible. All right, now that we talked about planting for the future, let's talk about planning for the future and go back to Matthew.
I like the way you think. Plan for the future. Think ahead. Be prepared. So, to get prepared, we need to know what we need to prepare for. And that thing is inflation. You might hear a lot. You might see it thrown around in the news. You might hear people worrying about it. What does it mean? And all inflation means is that prices go up over time. So the same amount of money buys fewer things. So it's not about the thing becoming more or less valuable. It's the fact that the same thing requires more money to buy. And this is the example we have on the right, Big Mac prices. So Big Macs, a lot of people love them. They're everywhere. Back in 1990, a Big Mac cost less than $1 US. In fact, it was 75 cents, which is wild. But in 10 years, it more than doubled, and it was $1.89. 10 more years, we're at 3.58. And 2 years ago, we're coming up on around $6. So same burger, a 7 times increase in price in over 30 years. That, my friends, is inflation. So before we go on, just want to make sure this is super clear to everyone. Does anyone want to get into any, more details, or just, what do you guys think? Can we move forward, or do we want to spend a little bit more time?
Uh, Arna, I see. Arna, you have your hand up. Did you have a question?
No, I actually wanted to answer the first question.
Oh, okay.
Well,
So
you know what? That's actually let's roll with it. And in answering the first question, maybe you can reflect on how that connects to what Matthew just talked about.
Okay, so I think, like in this example, it's telling us that the price is gradually increasing with time. So, this is what inflation means, that when price of, suppose you take a pencil or anything, gradually increases with time. Like in this, Big Mac prices are increasing, and at that time, in the question, I would buy my sneakers because with time the price of the sneakers would also double, or it would increase. And then if I save my $100, then I would buy lesser and fewer things compared to the sneakers. I would buy my sneakers and then sell them at a higher price.
Oh, very smart. And you connected the dots perfectly. Awesome.
Thanks.
yeah, I love it. Okay, so moving on. Purchasing power. If we're talking about $100, what can it actually buy? So today, $100 is worth $100. Pretty simple. But as we saw with the Big Macs, in 10 years, $100 will not buy you the same amount of stuff. So at 3% a year, in 10 years, it's lost more than a quarter of its value. It's only going to be worth $74. And in 20 years, almost half of it is gone. It's only at $55. So inflation is this invisible tax on your savings, on everything that you have. So you don't necessarily see it as a normal tax that you have to pay out of pocket, but it's still there and it's still just as real. And this is in finance what we sort of call it's like the time value of money. So over time, you need to put your savings to work. Otherwise, you're losing that value gradually but consistently. So inflation is that invisible tax. Why does it happen? Right? Like you could think, well, if a Big Mac is still a Big Mac, if sneakers are still sneakers, if a pencil is still a pencil, then why would its price go up over time? That doesn't make any sense. Nothing changed. And the reality of it is because it's not really about the item, it's really about the money. So if there's a lot of money in circulation, we call it the money supply, then there's the same amount of stuff out there. It's the same sneakers or Big Mac or a pencil, but there's more money. So if there's more money, but the same amount of stuff, that means the price for that stuff will go up. And I know that could sound a little complicated, but that's at the heart of the matter. High demand. So if there is an item like a PS5, supplies are limited, but a lot of people want it, so demand outweighs supply, prices are going to go up. Similarly, supply shortages. So with COVID, a few years ago, you guys may or may not remember that there were all of these supply chain disruptions all across the world. And because there were fewer items that were available to buy, the items that were available, they went up in price. So inflation happens because of these factors. I guess we'll take a moment and we'll open up the floor.
Okay. If we have, we've got a few questions here, so I believe we're going to start out with Maheen. Maheen, you said you had a lingering question?
Yes. So my question was that why does the prices, rise when there is more money? Like why?
Okay, so actually, maybe we could answer that by going through this slide because it exactly addresses your question. So let's talk about pizza. So here's an example. Imagine your class orders one pizza to share among 10 people. So one pizza, 10 people, everyone gets a slice. Cool. Now, your teacher gives everyone an extra $10. And everyone wants more pizza, but there's still only one. We ordered one pizza for 10 people. Now everyone has 10 more dollars. What happens? Well, the pizza prices rises because everyone has more money and everyone still wants that pizza. So more money, but the same amount of goods equals higher prices. It's exactly why. So when you have more money and the same amount of stuff, the prices go up because everyone still wants that stuff and everyone has more money to spend on that stuff.
So just to clarify Matthew's point there, you've got one pizza, and let's say initially maybe it was $5, or let's say it was $5 that pizza cost. But then all of a sudden there's $100 more in the room. The price of that pizza just could potentially go from $5 to $105 because there's still only one pizza.
Still
But
only one pizza.
Still only one pizza, but the amount of money that's in circulation in the room has just gone up. And that pizza, still the same pizza, the ingredient still hasn't changed, still tomato, cheese, and dough, but the amount of money circulating in the room. And I think the pizza is a great example. So
Uh,
let's go back. We have one more question just to touch
Yeah,
on
let's get it.
here. Diara. Diara, you said that you had a doubt
yes, so
to this.
I am still somewhat stuck on the sneakers because um for the $100 might be like the in the 1990s the $100 are $100, but in the 2000 they turn into 74. But I think that the sneakers are depreciating assets because they are $100, and that's not a small amount of money. And if there are depreciating assets, so like they decrease, the amount of the sneaker should decrease after 10 years. So why not buy it in 10 years?
Say that again. So why not buy the sneakers in 10 years? Because the sneakers, what price will the sneakers be in 10 years?
Like the $100 turn into $74. But for the sneakers, they might also be $75 because they are depreciating assets.
Well, I mean, if it's literally the same pair, then yeah, it's been worn for 10 years. So it's not going to be worth the sticker price that you would get brand new. That's for sure. But do you really want to wear 10-year-old sneakers that someone else had? So
Like
yeah,
it's not in the sense that anybody else has worn it or something, but like sneakers should be a depreciating asset. So the cost of the sneakers might go down.
it only
I
depreciates if it's used.
Well, I think Diara's point actually is very interesting, and this gets back to the other point that someone made about whether or not the shoes are limited edition. So whether or not those sneakers are going to appreciate or depreciate in value. We're getting pretty complex and we're getting a little bit ahead of ourselves. We're going to resolve this later as Matthew talks about how do we counter inflation, right? How do we make sure or how do we deal with the situation with, essentially, how do we make sure that the value of those sneakers continues to increase faster than the reduction in that money? And that's the difference between
Yes.
just buying and a regular pair of sneakers or maybe those Air Jordans that are going to sit in a box and actually, but we'll get to that. So Diara, you're 100% correct. You're just cruising ahead of, you're 10,000 miles ahead of us. We just got to slow down. We'll come back, but you're absolutely right. Okay. You're welcome. And real quick, just before we move on, Matthew,
Yeah.
Radit, you've been very patient. I've seen you've had your hand up for a little bit. Let's get to your question, and then we're going to move on because Matthew really wants to underscore some of these concepts.
Mm.
So
That's
I was
valid.
talking about demand, supply, and then money. So basically, when the demand rises and the supply drops, the money increases. So in the coming years, why can't you invest in gold? Because the gold prices are increasing and the supply, the mines are decreasing because they can't find gold. So why not invest in gold and then earn more money instead of keeping it with you and the price would decrease like 74 in 1 decade and 55 in two.
No, that it's a really cool question because, and not to get too technical, but gold doesn't pay dividends. Gold doesn't pay interest. So there are all these other assets out there, like stocks or bonds, that have real cash flow that gets generated on a regular basis. So if you're looking for a hedge against inflation, could gold be part of your portfolio? Maybe, sure. But there's all these other assets out there that actually will justify their value by paying you cash regularly, which is something that gold doesn't do. So there's a lot of reasons to consider gold, and there's a lot of reasons to consider other assets besides gold.
So, but why can't you invest in something that gets you money? And then in the future, why can't you buy more sneakers and more varieties that you get?
No, exactly. No, that's exactly a really cool way of doing it. You invest now so that you get some good returns, and because of those returns, you could actually buy more in the future than you could right now. So that's a very, very good way of looking at it.
Ah,
Okay, thank you, and thank you,
yeah.
Matthew. And I think
आवाज नहीं आ
if you're
रही.
looking for new interns
बाहरों
for your
5 मिनट
next
लगेंगे.
multi-billion-dollar investment fund, I think we've got a good pool right here. Everyone
Got it.
is so smart thinking about all the different aspects of this. Let's let Matthew move on now, and he's going to really drill down into the fundamental basis of inflation and this really important point here.
Okay, so right now, when we talk about inflation so far, it sounds like a pretty bad thing. We're talking about avoiding it or beating it, or why does this happen? This is so bad. But in reality, it's not it's not one dimensional. It's actually really good to have a little bit of inflation. So back in the US, the Federal Reserve, the central bank, has like a soft inflation target of 2% per year. So again, they're not trying to keep it at zero, and they definitely want to avoid deflation. So it's like, hey, if inflation was so bad, wouldn't we want things to cost less? The answer is no, we wouldn't. So why? Why do we want some inflation between 1 to 3%? Because it has quite a few really good attributes. So it encourages people to spend and invest now. So an economy grows when people are spending and buying and doing things with their money, when money is generating profits for companies so they can hire more people and invest in new things. If, everyone's just sitting on their cash, hoarding it, putting it in their mattresses, storing it in their closets, well, then none of that activity happens. So a little bit of inflation will spur people to do that kind of thing. And as businesses earn more, they can hire more workers. And when they have more workers, they're producing more things. Those workers have their own earnings. They can go and buy those things. So it's a really nice virtuous cycle. Borrowers benefit too, because if you have a loan or a debt right now, if there's inflation, then easier for you to pay that off. And so because it helps those borrowers who are injecting money into the economy and helping growth, or they're investing it, because it's a little bit of an accelerant to that process, that inflation is pretty good. And again, the Fed 2% Goldilocks, not too hot, not too cold. It's right where we want it. Bad inflation. And this is why we spend so much time focusing on why inflation is something you need to plan about, because your savings will lose value faster than you can invest them. We're going to get into that in a few examples. Um, Prices rise so fast, wages can't keep up. We have that could be called hyperinflation, and we have a few slides on that. You panic buy goods before prices rise further. So if you know that inflation is really crazy and it's going at a really high rate, well, you want to buy as soon as you can, because if you wait just an hour or a day, it's going to be even more money. So this causes really strange dislocations across the economy. It's not an efficient pricing mechanism. And as such, businesses really can't plan. So if you are a company and you're trying to deploy capital and raise capital and hire people and enter new markets, create new products, all of that, well, if there's really high inflation, you can't plan for anything because prices are just shifting all the time. So if the companies aren't really planning well and coming up with well thought out strategies, that's going to have a really bad effect on economic growth too. So good inflation, bad inflation when it's too high. Hyperinflation. So this is what I was talking about when things are out of control. Throughout history, all different parts of the world, there have been times when inflation is just sky high. And you see how it just devastates everyone, just normal people. So in Zimbabwe in 2008, like 89.76 trillion% annual inflation. So prices were doubling every day. Think about that. If like, hey, today that slice of pizza is $2, then tomorrow it's 4, and then the day after it's 8. You can't do anything. Your life is going to be really precarious. So a loaf of bread cost $35 million. There were $100 trillion bills, and they were still worth nothing. That is why inflation, when it's too high, that's why it's bad. In Germany, after World War I, the workers were paid twice a day so they can spend before the prices went up later that day. So people were burning money for heat. It's like because wood was more valuable. Wood kept its value more than cash. And a little bit more recently in Venezuela, like over 1,000,000% annual inflation. Oh, what happens? Stores run out of food. It's all that panic buying. People, their life savings become worthless. Millions of people left the country. A cup of coffee, because of this doubling process, because of this compounding that we talked about before, we'll talk about again, it went from 25 cents to 2 million bolivars, their unit of currency, in a year. Can you imagine that? So today, like, yeah, I'll get a coffee for a quarter. A year from now, that'll be 2 million. Like, it's wild. And so this happens. This is something that every central bank, every economy wants to avoid this scenario. So I guess take a breather there and let's open up the floor.
Yeah, this is and these are the extreme examples when inflation becomes hyperinflation. And I think it's also important just to underscore what Matthew's talking about here is we're talking about currency. So the currency of these individual countries, we're not talking about an asset or a piece of gold. It's the money that is changing by more of that money being introduced in terms of what happens as a result of that. Now, let's go to a few questions here. Aryaman, are you able to turn your camera on?
My camera is on only.
Okay. I guess we're not seeing you because of the background, but if you could go ahead with your question, go ahead.
Sir, I wanted I had a doubt for previous question. It was about those sneakers. So what I was saying was, sneakers are bought when there is a hype. Like most of the things, that's how it works. Okay. So one sneaker can max to max have a hype of max 2 years. After that, the price of that particular model of sneakers will go down unless and until it is worn by some NBA player or someone. So what we can do is that buy that sneaker at that particular price and then sell the limited edition sneakers on some specific website where you only get those limited ones which are not available in every country or somewhere. Then you can sell it for more price. So you get more profit and it becomes a fast earning thing also. But I don't think sneakers can, like they have a good amount of value for inflation for a long period of time. Particular models only last for a particular amount of time.
Yeah, I'm smiling so much because I actually have a business that is all about collectibles. So when you guys are talking about, is this limited edition? It's about the hype and trying to have a view on if it's going to go up or down in price over time. This is my day-to-day life. So I am very happy you guys have such sophisticated opinions on this because it's actually a very interesting part of the economy.
Yeah, sir.
And
So, main thing what I wanted to ask is that there are particular objects or things which have a particular duration of time from like the amount in what we buy them. So for sneakers, like I said, it can max to max go in the same price for 2 years, but after that it will keep dropping down. But if we see in stock market, there are few stocks like gold, like one guy said, and it will keep increasing. So inflation or deflation, it can matter in different kind of objects and materials, depending on how much they are used and when they are used.
Yeah, I had seen really quickly in the chat as it's been going by, someone asked about deflation, and I used that very quickly. And I'll just make sure that we're all on the same page. So if inflation means that prices are going up, deflation means that prices are going down. So we're talking about the same items, the same objects that you can buy, but with inflation, the price is higher. With deflation, the price is lower. So the pizza today costs $2. With deflation, tomorrow it might cost $1 or $1.50. So prices are going down. Deflation is really bad for the economy. And that's because if you have that moderate inflation we were talking about, that helps and encourages people to spend and to invest and to get the money flowing. With deflation, well, if you know prices are going to go down, you're going to sit on your money and it's not going to circulate. And so businesses aren't going to be investing and hiring and selling new things. And all of a sudden, that becomes a huge headwind to growth. And that's what Japan had gone through for 30 years. That's what China's going through right now. There's a lot of interesting scenarios. We can get really deep into it, but just to make sure we're all on the same page, deflation means when prices are going down.
I have a question.
Sometimes deflation can be good also, right? Because some people, example, they haven't entered the market and see one stock of Nifty 50, for example, it was around 15K or something. But now because of the war happening between US, Iran and all that, the Nifty 50 went down, like it took a very bad hit. So a few players can still go inside the stock market and buy the stocks because it will like inflation will occur again after the war stops or when matters cool down. So
yes,
people
that's a
can.
very good point. Thank you, Aryaman. And certainly, this is where it becomes more complex when there's geopolitical influences. With collectibles, we're talking about perceived value. I think really what we want to come away with today is a core understanding of the basic concept of inflation and what happens. And this goes back a little bit. We can go track back a little bit for anyone who was here for our blockchain workshop when we talked about cryptocurrency. When you increase your liquidity pool, the more of that cryptocurrency you put out there, that is going to change the relative amount of currency to the value. And that's the core of what we're talking about, is that as you introduce more money into the system, that is what is causing inflation. Purely looking at the currency in the economy and not perceived value and other things like that. Okay, we've got a few more questions here, and we want to give a chance for everyone to really clarify. It's helpful to hear these different points. Vidika, you've got your hand up.
Yes. My question was, how can countries keep the rate of inflation low?
Wow, that is an excellent question. And that is what occupies the minds of central bankers every day. You need to, and again, this is a highly technical topic, but you need to control the money supply. Seth was even talking about it right now when it comes to cryptocurrency. So you need to make sure you have a stable and slightly growing money supply, and you will do things like raise or lower interest rates according to the economic cycle that you're in. So if you're in a growth cycle, you might want to raise interest rates. So you lower that velocity of money and you ensure that you don't become overheated with runaway inflation. If you're going through a recession or a slowdown, you'll cut the interest rate. So you'll increase the velocity of money, and that will help get you to a healthy rate of inflation. So again, it's super technical. You could do things, a lot more things than that, but it's mostly about setting the core interest rate.
Mm.
One question I saw here in the chat was from Arna, and Arna, the question was, what is the Goldilocks? Goldilocks is sort of like this perfect zone, and it's taken from this Western fable about this person who didn't like things too hot and didn't like things too cold, but they wanted it right in the middle. And that's sort of what we're talking about here with this Goldilocks zone is we don't want to have we don't want to add too much currency, but the problem is if we're not inflating and we risk the chance of going in the other direction. And so that pizza that was $2 is going to be $1 tomorrow. And what, as a result, in that classroom, you're going to have more people fighting over that pizza. It creates, sort of negative economic influence is what we're talking about, and what that does in terms of wages as well. And then also, as we look at sort of like the value, and I think this is one of the key takeaways that we want to talk about here is it's not just the value of money. It's not just the value of currency. It is the value of money over time. So we've got two factors here. We've got the value of that currency, and then we have how does that value change over time? And that's what we're really focusing on. Now, with inflation, that amount of currency relative to that value is going to increase. But with deflation, that amount of currency relative to that value is going to decrease. And that's sort of the fundamental principle that we're talking about here.
Yeah. Just to quickly build on what Seth was saying, because it's an excellent point, that
let's make sure we're muted, everybody. Thank you.
Since we're talking about these inflationary and deflationary cycles, it's over time, right? So that's when we look at different examples, like those hyperinflation countries, like Japan in the 90s and 2000s, like China now, the temporal dimension, the time dimension is critical because everything is self-reinforcing. It gets on a cycle, and it can be really difficult to overcome. In America, we had very serious inflation in the 70s, and it took a Fed chair, Paul Volcker, to raise interest rates to like 10% per year, really high, for a long time, and to cause a lot of economic difficulty to overcome that, because again, it's about time, and it has all these strong self-reinforcing principles that exist in a cycle.
Really great point. Yeah, and then sort of economic cycles, and that's what these central banks are doing. And we talked about central bank authorities in our crypto workshop as well. What they're doing, and you'll hear this word or this term, monetary policy. And that's not about how much money they keep in their wallet or in their purse at any given time. That monetary policy is really, they're trying to decide how much currency should we bring into the system, and then that interest rate is about, okay, almost what's the cost of bringing more currency in, and that is what they're trying to balance against the economic movements that are moving up and down over time. And there's a lot of complex factors there. Kavya, you've been very patient and had your hand up. Go ahead. What's your question?
Thank you, sir. Actually, I have two questions. I've been waiting from the pizza thing. So, first is that if the when the is it that when the demand goes up, the prices go up? And second of all, does demand influence inflation?
So again, like it's a time-based, yeah, it's a time-based phenomenon. So it isn't just about demand, it's about the money supply and it's about the amount of stuff available to buy. So you have to look at all of those factors together.
Yeah, great answer. Yeah, and to get back to Matthew's point about the inflation that almost became hyperinflation in the US back in the 70s, part of that was instigated by the oil crisis that occurred at that time. So there are clear factors here in terms of, and even today, in terms of the similar geopolitical influences, supply and demand. But really, what we want to talk about is the core aspect of inflation and how that is driven by the change of the relative amount of currency to the value over a period of time. It's so simple, but it's so fundamental. And so I think that's really kind of what we want to talk about. All right, we've got a few more before we jump into the breakout room. Neva, you've also been very patient. Go ahead, your question.
So I wanted to go back to the initial question of the sneakers. I believe that we should invest the $100 that we have in schemes like equity funds that are going to beat the inflation, as India is like an emerging market. So like with the returns that you receive on the $100 in the long term, like that is 10 years, you can buy better sneakers and that too like with better variety.
That's a really cool way of looking at it. Yeah, you have index funds that track the equity markets all across the world, like in developing economies, and those can give some really good returns since those markets are growing so quickly. And maybe you invest in that now, so in the future, your returns are so good, you could buy 100 pairs of sneakers. So it's a really cool way of looking at it.
Awesome. All right. And Arohi,
Excuse me, sir.
go ahead, Arohi.
Yeah, so my question was that why is inflation like needed for a country? Like why at least 2 to 3% of inflation must happen each and every year for like a country to develop?
It's not that it must happen, it's just that it's really helpful. It's very helpful because it gives a little bit of encouragement for people to spend, for businesses to invest, but it's not too much where there's just absolute chaos the way it is with hyperinflation. And it's not deflation either, which has the opposite effect. So if you know prices are going to go down, you're going to wait to spend. And if everyone's waiting to spend, that means your economy is actually shrinking or not growing at all.
Okay, thank you.
It's definitely one of the carrot and the horse sorry, the carrot and the stick analogy for the horse. So this is a classic analogy where you've got a horse, you've got a carrot that will make the horse want to go after that carrot. Now, that pressure, or what that is with inflation, is saying that, look, you want to get this now. You want to get the sneakers now because next year they might cost more, right? And so that's kind of pulling along that driving the economy. That and now the other thing as well is in terms of sort of borrowing, and I know Matthew might get into this also. Um, if you want to secure an asset like a piece of real estate, if you're able to do that now at the present currency, then it's going to be better than later when it may take more. Now, of course, real estate values change, so that's not the clearest example, but it's just another example of why inflation, it's good to have a little bit that gets that horse of the economy excited about that carrot and sort of going after opportunities. Businesses go after opportunities. And so again, trying to keep it very pure. All right, I think we got we're going to go back to the presentation real quick before the breakout room. Day, I do see you. Don't worry, we'll get a chance for your question, and we do see you there. Don't worry, no worries.
Yeah, I love that. The horse of the economy. Yeah, that little bit of inflation, that'll get the horse excited with that carrot. So protecting your money. If you know inflation is happening, not even hyperinflation, but just like good regular inflation of 1 to 3%, well, you need to make sure that your money doesn't have to pay that invisible tax of 1 to 3%. So here's the problem, right? If inflation is at 3% a year and you put your money in a savings account and it's paying 0.5% interest, well, bad news. You're actually losing 2.5% of your wealth every year. You're not making money, you're losing money. So after 30 years, 10K in savings might only buy you what 4K buys today. It's a bad move. This is what we call real versus nominal returns. And that's just a fancy way of saying, the returns that you get with interest or without interest. It's by taking, inflation. It's about taking inflation into account. So your investment return, you have to expect it to beat inflation, or else you're actually losing money. So with a savings account example, if it looks like you're making some money, it looks like you're making 0.5%. Well, if inflation is 3%, you're actually losing 2.5% a year. If, on the other hand, you're at the S&P 500, which is a stock index here in America, well, then the average historical return is 10% every year. If inflation is 3%, you're gaining 7% a year. Your real return, your inflation adjusted return is 7%. You're making money every year. This is great. What are the types of investment? So we've talked about a few of these, right? Just now we're talking about stocks. The average return is 10%. Average is key here because you have some years that are really bad, like during the financial crisis. You have some years that are really excellent. So over the long term, it averages out to 10%. If you get a piece of a company like Apple, when they grow, you grow. It's great. Real estate, average return 8 to 12% a year. Again, there's a ton of variance in this. Real estate in the commercial sector in Manhattan, it's going to look a lot different than real estate in Da Nang in Vietnam. But buy property now, you can sell it, you could take out loans against it, you could rent it out to tenants, medium risk. Own your own business. Sky high limit. You could make a lot of money and the risk is just as high. So most millionaires, they built their own business, high risk, high reward. It's a fun time. We can talk all about that. Collectibles. This is my company. Collectibles are great. Rare sneakers, trading cards, all of that. It's a variable risk. And the return also is very variable, but it's very interesting. It's a market that is getting more and more attention, and it's could be a cool thing to add to your portfolio. Just something to keep in mind. Risk versus return. One of the absolute core rules of finance is higher return requires higher risk. So if someone
Could
is
you
telling that, hey, look, I can give you super high return and it's risk-free, do not listen to that person. The only reason why you can expect a higher return is because the risk is correspondingly high. And you can see what that sort of looks like. A savings account is really safe. So the bank doesn't need to pay you very much since it's like, yeah, you definitely know the bank is safe. It's cool. Government bonds, still very low. And then it goes up to real estate, S&P 500, and your own business. And the reason why, again, if there's some venture, some business, some product that needs capital and it has risk. Well, they need to compensate the investor for taking on that risk. And so that's why it tracks. If there isn't a lot of risk, they don't need to pay a lot. If there is a lot of risk, well, because the investor might lose their money, they have to pay a lot more to access that capital.
Can you go to the previous slide, please?
Seth, should we do that?
Before we
Just
go,
a second.
okay, well, and we'll have a chance to touch on any concepts that we need to in the breakout rooms, which are going to be opening up in about 5 minutes.
Sir,
Before we
according
do
to
that,
you, what is the best investment?
let's please wait for your turn. Thank you. And that's such a big question, and we're not here to advise on
Exactly. No,
portfolio creation. Great.
not
And
at
I think
all.
that's the magic question everyone would like to know. So really quick though, before we jump into the breakout rooms, Riday, I know you've been very patient. Go ahead. What's your question, sir?
Okay, so I have two questions. First of all, is that investing is basically gambling, as you just conveyed in last session,
No,
because like price
I
can go
wouldn't.
up and down.
Again, to be clear, right? Investing absolutely entails risk, but gambling is just totally random. Where like anyone who's playing in a casino has the same chances of winning or losing as anyone else. Investing done properly, it's educated. You're going to do due diligence, you're going to do research and analyze. So there will be a very informed view of how you put your money to work. So I think there's a very strong distinction between gambling and investing responsibly.
So my question was that I've heard that inflation only occurs like when the demand is high, but the products are less in quantity, so the prices go up. So, can you clarify? Am I right or am I wrong?
It's more about different amounts of money chasing different amounts of goods. So it isn't simply about one item being like really hot that everyone gets. Not really. It's about this dynamic interplay of money and supply and time.
And my last question was that, you said that government prints money, so that is also one of the reasons because of which results in inflation. Like, but government does not give money for free, right? So.
I mean, so you could actually say that in some really esoteric situations, not only does the government give money for free, they actually pay you to take it. So with quantitative easing, with the Fed discount window, there are some really interesting things that central banks can do to inject liquidity, to inject money in the economy. That is very far outside the scope of this workshop, but it's excellent that you're thinking about that because it really is an important part of the inflation story.
And
um,
Renee, thank you. Great questions. And actually, here in the United States during COVID-19, there was an increase in the currency pool, and the government did issue checks directly to citizens. So it's about the closest thing to free money, but that's essentially, kind of what was going on there at the time. So very, and the level of complexity is why we have people like Matthew, and why you need to go to uh, a a school where you can learn all of this. If someone could just pick this up,
Absolutely.
in 15 minutes, and Matthew would be out of a job, as
Oh,
would
what do
the
I do?
entire
Yeah.
financial industry, right? So everyone just know if you're feeling like, but I don't quite understand how this connects to this, that's okay.
That's
And
okay.
that's
Yeah.
precisely why we have investment professionals like Matthew. And so I think that's just important to bear in mind here. Don't feel like you're missing part of the picture or anything like that. It's just the picture is very big and it's very complex. And so I think that's worth noting. I
Yeah.
think we're probably around where we should be heading into the breakout rooms right now. Matthew, is there anything else you wanted to underscore before we do that? And also, if we could talk about a little bit, segue into that breakout room activity.
Yeah, we'll go through something super quick and then we'll talk about the breakout room topic. So I've said it before in a few sessions you guys might have been in, you might remember, compounding is magic. It's the eighth wonder of the world, according to Einstein, and he was a really smart guy. So time is your friend if you're smart enough to know it's your friend. Start early, invest now, save now. If, once you guys are graduated from college and you're in the workforce, like don't wait until you're in your 30s or 40s. When you are fresh undergrads, go out, save your money, invest it. Because as you can see with the chart on the left, if you put your money in the S&P 500, 10% a year, then $1,000 becomes like over $170,000. That's a great return. And it's just sitting there. So compounding is great. And keep that in mind. Group challenge, build a $10,000 portfolio. We were talking about beating inflation, real returns, inflation adjusted returns. So choose your investments, explain your reasoning, present it to the class. So that's your mission. At least two investment types, two asset classes, as we call it. Explain why you chose those investments, what your expected return every year is going to be. Just as important, what is your risk? How can this go wrong? And then name one way that inflation could hurt or help your portfolio. Be creative, make sure your reasoning is clear, understand the risks, and let's make sure we keep inflation in mind. When you present, speak clearly, cameras on. Again, be clear about your logic, take questions, and everyone listen. So there we go. And we could go through the key takeaways later. But right now, let's break out into the squads.
Matthew has still two queries.
Okay, everybody, we're going to start assigning you to the breakout rooms, and we're going to have about 25, 30 minutes in the rooms, and then we're going to come back together here to present. Have fun with this, okay? And as we know, Matthew, who's an investment professional, is now working in collectibles, so some of those original Pokemon cards are no joke in terms of their value. You want to put that on your portfolio, that is great. But be sure that you also have something on the stable end of the spectrum as well. We want to see a nice balanced portfolio. It can't be all Air Jordans, okay?
Yeah, balance it out, guys.
All right, we should see the breakout rooms showing up here in a moment. And remember, in the breakout rooms, be respectful of each other. There's also an opportunity as Matthew and I, as well as the other team members from the Growth Valley community, will visit and give you some pointers if you have any follow-up questions that you need to ask.
But I still have two queries.
Okay. So, breakout rooms, here we go. I will join $1.
And don't worry if you're not assigned yet. We're working our way through the list, and you'll be assigned to a room here momentarily.
Sir, I accidentally left my breakout room. Could you please share?
Okay. Go
So
ahead.
it's there in more breakout rooms, and then there's a lot of options.
1 second, Ridit, we'll put you in the correct room. Please, Seth, you can go and visit the others.
I know
You
what's my
got it.
room. It's Vision 1, right?
Yes, it's Vision 1, so please join that.
Yeah, so I'm trying to
The
join.
rest of you, Shazan, can you please join your room? Ayan, Nidhi, please join your rooms. Arush, please join your room. Shazan, can you please join your room? Ridit, Kartike, can you please join your room?
Sir, I can't find oh, got it, sir.
Yeah. Rohan, can you please join your room? Do you know your room?
Which breakout room am I supposed to join?
Rohan, you are in. Who were your teammates?
How to join the room?
So last time I was in Vision 2.
Yes, Ridit, you were in Vision 1, right? No.
Sir,
Yeah, Vision 1, please join that, Ridit. 1 second, please.
sir,
One at a
how
time.
could I join my room?
Shazan, 1 second, please. Firstly, Rohan, you are in. Rohan, please join Innovation 2.
Yeah.
There you go. Please join that. Next is Kartike. Hello. Shazan, I'm just
Yes.
you would have gotten the you should have gotten the invite to join your room, right?
No, sir, I haven't got it yet.
1 second. You should be in Tenacity 1, but
Sir,
I'm moving you to Tenacity 2 now, and then I'll put you back.
Yeah,
Sahat,
sir, I am in Tenacity 1. Tenacity 1.
Sahat, sir.
Yeah. Yeah, I've given you the recording permission. Go.
Yep.
Yeah, sir, but how could I join my room? There is no link.
You're not getting any option to join?
Yeah, sir, there is no link.
It
Shazan,
won't.
listen, there are 3.
What? Right.
Zohan, can you please join your room now?
Yes, sir, I'm joining.
Thank you for the help.
Rudra, wait. Sorry, sir.
तो क्या करा जाए अब
Do you know what is to be done as a breakout activity?
Join your room now, Kyra.
Yes, sir. Thank you, sir.